time for a little New Year's cheer. My next guest sees gains on the horizon for 2011. And for a look ahead at the new year for markets, we're joined now by Daniel Wiener. He is the chairman of Advisor Investments, managing, what, about $1 billion right now? $1.2 billion. All right. So you've been looking at what's happened this year, and we were just talking before the break about the idea that there is no new normal. It's pretty much normal. And we were talking to Bert Fleckinger, and he says $520 billion retail sales. This is a record, period. This is not like a record now, a record 10 years. This is a record. And it's not because it's just coming off a low base, because this is real money. I mean, you got to add inflation, but $520 billion, it's nothing, nothing to sneeze at.
As we were talking about before, the U.S. economy is going to end 2010 at a record high. We're at about $14.7 trillion in today's dollars. On an inflation-adjusted basis, we're about, at the end of the third quarter, we were 0.6% below the inflation-adjusted peak in GDP, which was back in 2007. We're going to bust right through that in the fourth quarter.
So how did investors get scared so easily? Because, indeed, we've been talking about whether people should be adding more risk to the portfolio, maybe taking some of their money out of bond funds.
Well, how'd they get scared? Come on, you had a decade that included two huge bear markets. You know, everybody seems to have forgotten the tech bear market that we had between 2000 and 2002, because coming out of it, we had a tremendous bull rally. And then whammo, 2008, we get hit by the financial crisis. So first it was the techs, then it was the financials. People got scared. But the bottom line, as far as I'm concerned, is it's not a new normal. It's a normal. The impingements, of course, are the unemployment issue. But really, we look at a 10%, call it 10% unemployment. Normal for our economy, when we're going full bore, is 4 to 5% unemployment. So really, we need to add about 5% in terms of jobs, not 10%. We never get zero unemployment. That's just not possible. So yes, those are people who are out of jobs. We need to get them working. We need to have them spending to push things along. And then the other big issue is the housing business. And, of course, a lot of the jobs that have been lost are jobs in the construction trade.
Right, housing related.
Right.
So would you be then betting on a resurgence in housing? I mean, do you think that is one of the areas to be in 2011?
No, personally, I would not. I would be betting, though, that the consumer, as your prior guest talked about, that the consumer is going to be buying more and more. They are loosening the purse strings a little bit. And you know what's interesting is they're also the consumer's balance sheet is actually getting a little better. They're saving a little more, and yet they are spending more.
Well, indeed, Bert was saying that one of the things about it is that people are using their debit cards and using cash to make their purchases more often than they are using credit cards.
And isn't that a good thing?
Because they're not spending money that they don't have.
That's exactly right. That's exactly right. So what's interesting is, you're seeing little incremental gains in incomes. The incremental gains in spending are just about matching the gains in income.
So where do you put the money next year? Where do you start to sort of allocate money in the portfolio?
We've always allocated our clients' money across a diversified portfolio of 6 or 8 really good managers in a variety of places in the market. The area that really hasn't done well this year, and I think could come to the fore in 2011, is the large cap, name brand, dividend paying stocks that have strong balance sheets and strong fundamentals. They have been overlooked because, again, it's been a normal bounce out of the bear market.
So everything moves higher, so there's no discrimination.
There's no discrimination, and particularly none in terms of risk or in terms of fundamental quality earnings, quality balance sheets. The Dow's up 77% off its low. The S&P is up, I believe, 100%, and small and mid-cap stocks are up 125% off their lows. So, we've had a great bounce for the little guys. It's time for the big guys.
All right. Daniel, what about gold? Gold is one of those favorite investments, at least so far this year. A lot of hedge fund managers have piled into gold. What's your thought about the precious metal?
Well, very risky. It's a big risk trade. But one of the reasons that at least the people that I talk to have said is the reason that the hedge funds are getting into gold is it's a place where they can gain a lot of leverage. They're looking to get leverage because if you're going to make your 2 and 20, particularly the 20.
Your 2% that you get on the assets under management plus the 20% you get on the profits.
On the profits. And you know, for all that the talk of gold and hedge funds, in general, hedge funds have not done well this year. This has not been a good year for hedge funds. So these guys are looking to get some leverage, and gold, the precious metals, but you know, the metal that's done so well this year is not gold, but silver.
Silver.
Silver's been just cranking in the
And that
markets.
also has some industrial uses.
Absolutely, absolutely. You know, gold is, it's funny, there's a lot of demand out of India. There's a lot, obviously, there's some demand in China, but gold doesn't have much use other than being stuck in a vault somewhere. You know, the cost of carry is high. There's no dividend off of gold. So I tend to let other people play gold. And the other thing that I've done some research on is it takes a lot of gold in a portfolio to make it move. So how much are you willing to risk in an allocation to gold to get what kind of return on the back end? Because if it goes against you, you get nailed.
Now, you've been focused, as you mentioned, on the managers. You like to pick good managers because you recognize they may have an edge in the marketplace. Does that kind of, does that argument kind of make you feel that the efficient market theories that you can't beat the market are great for theories, but in practice don't work out that way, that there are people that can beat the market?
Well, number one, there are plenty of people out there who can beat the market. But second of all, you know, one of the great efficient market theorists, Burt Malkiel at Chicago, recently wrote an op-ed about how he's investing in Chinese stocks. And he, in fact, runs a company that offers stock-picked indexes that you can run, say, an ETF off of. So for the guy who talks about efficient markets and, you know, just buy the market and go away, he's not actually walking the talk. He's
So you're picking the actual managers. So can you give us some idea of the managers that you're focused on this year?
Some great managers. First of all, I always point to the Prime Cap management team out in Pasadena, California. Excellent GARP managers, growth at a reasonable price. They've got a couple of private label funds, their Prime Cap Odyssey funds. Frankly, I hope nobody else puts any money into them because we own a lot of them. We like them keeping the funds small, keeping them very flexible. Their aggressive growth funds up, I think, around 25% this year, something like that. Don Kilbride runs a fund called Vanguard Dividend Growth out of Wellington Management. Real good value investor. You know, we were saying before the break that large cap dividend paying, strong balance sheet companies have not done well this year. When people start to focus more on the fundamentals, and when your year-over-year profit gains drop from, you know, the 50, 60, 100%.
Right, when the percentage numbers start to get a little more reasonable.
Down, people are going to say, oh, you know what, maybe I don't want those financials. In particular, I saw a number today that financial earnings are up over 1,000% year over year.
That's because they didn't earn anything before.
Exactly. So, you know, people are going to look to strong fundamental, big companies. Kilbride's portfolio, under 50 stocks. He gets concentration in his 10 biggest holdings. Doesn't do a lot of trading, but he trades around the margin.
Well, if you don't do a lot of trading, that doesn't also incur a lot of costs, right?
That's right. That's right. And so you can find good managers. The biggest headwind a good manager has is cost. If you can get funds, mutual funds that have lower expense ratios, you're going to be just fine. You know, you put a portfolio, as we do for our clients, portfolio together of excellent managers. These are guys who you can't hire if you don't have $5, 10, $20 million for each of them. And we can buy them for our clients for as little as $3,000 a piece.
Because the minimums are so high for a lot of these funds.
Sure. At Prime Cap, if you could get them to agree to take an account from you, that might be a $25 or $50 million account. Now, if I want to be diversified and I want 6 or 8 managers, I need 6 times 25 million. I don't have that. I know you do, but you know, being
as we say,
at Bloomberg,
as we say, in our dreams.
In our dreams.
But it's always good to be with you in reality. I want to
you.
thank you very much, Daniel Wiener, coming to us from Advisor Investments. Thank you very much.
Thanks.